All right. Hope everyone had a good day. And if there's any issues with audio, please just let me know. Let me check one thing really quick here. Looks like the audio is working okay. So, interesting day. And this is always one of those really interesting days where pretty much what happens is let's take a look at the daily chart. So, in the daily chart, we had this outside down day on Friday. Harvey, thanks for letting me know the sound's good. So we had this bar right here, big bear bar on Friday, outside down, testing very important support. The support, June 30th low, or the one of the closes over here. Anyways, outside down, possible sell vacuum testing the June 30th support level. And whenever you get big bar, sideways, another bar, overlap, another big bear bar, you always have to wonder, is this always in short, or is this the start of a trading range? So good bar for the bears, but where is the follow through? Now we have a bull bar closing on its high. So that is certainly disappointing for the bears. And that's what I thought what would happen today. Now, disappointment for the bears, good bull bar closing on its high. It's a second entry buy. The bulls, what do they want? They want to prevent this gap from closing. So they want this to be a sell vacuum, test of 4,500, test of the June high, and they wanted today to close on its high. So what are they going to want tomorrow? Tomorrow, they want another gap up. They want some sort of strong follow through buying into the close of tomorrow. More likely, it'll be something disappointing. This sell off is a tight channel. It doesn't look tight on a daily chart, but if we go to a weekly chart, this is what we'll see. There is that tight channel on a weekly chart. And this is actually pretty interesting. So you look at this right here. It's really important to have imagination about bars. And what that means is you have to think ahead. So you have a big bear bar. What would it take for you to buy above the next bar? This is a tight bull channel, but buy climax pause, another buy climax pause, rally, and then a big bear bar. So if tomorrow is a bull bar closing on its high, are you going to be thrilled about buying it? Or are you going to say, I don't know, it's a high one buy, but this last week awfully looks big. And if it's a big bar, it'll probably get a second leg down. All those combinations make me think that we're probably going to get a second leg. I don't think we're going to go above the high before we get the second leg. We might. It'll be interesting to see what tomorrow looks like. So let's see if we can get let's see if I can find an example. I'm searching. So as I often say, StreamYard is on this side of the computer and TradeStation's on that side. So that's why you see me turn my head so much. But if we look up here, we had a big bear bar. And that's kind of the same thing. Although this was more of a climactic rally. We have a doji. Who's going to buy above that doji? Probably not many traders. And if not many traders are willing to buy above it, more traders might sell. And that's why we just gaps down on the next bar. So we're getting a bull bar here. But if I'm a bull and I bought the low of 2 weeks ago, so I bought this low and then this is my follow through. Yes, technically, if you bought the low of that bar, well, first off, we don't know if this bar probably didn't go down. So if this bar rallied up to here, if you bought this low, you likely bought it on the way down. So we can see that on the daily chart. Daily chart, let's look here. Yeah, so there is. This is actually interesting. It's hard to see, so let me see if I can explain this better. You see this red line? If you bought the low of that line, notice the daily chart. What do you notice that happened? So the bulls, they bought the July 27th low right here. There's the buy. So the market went down, bulls buy, and it's reasonable. They probably put a stop maybe something like that projected down. Those bulls will buy and scale in once or twice, but if the follow through down is too much, they'll exit. Well, look what happened. We sold off, went a little further. And what do you notice about the high of that bar? Who can tell me in the comments what happened on this current bar that I'm pointing at? Got out break even, bulls getting away. I'm assuming you mean getting out break even. Yeah, more people are saying break even. Very good. And so if we think about that logic, this is actually, so if we think about what's going on here, you buy that low, then we get follow through down. You have some traders who did not. There's a few things. One, we know there's bulls who bought this low and scaled in lower, and they're disappointed. So we know those traders are uninterested in buying at this price level again. They're sellers. They're interested. They bought. They scaled in. They're probably going to sell at this red line. Now the bears know that. The bears aren't stupid. So the bears, they're going to sell at this red line, and they're going to join the bulls selling out of longs. And that often creates a second leg down. And the second leg happened in basically one bar outside down. And because of that, that increased the chances that this could be more of a vacuum test of support. And there's other problems too. We sold off on this bar and we hesitated just above major support, 4,500 in the June 30th low. Now, this is all intra bar. On the weekly chart, all you see is this. I still think, though, there's sellers somewhere above, but the pullback will be disappointing. And the reason we have a right type bull channel, disappointing bear bar, probably sellers above, and back to the daily chart, what I just talked about. Typically, if a trend is strong or a breakout is strong, one of the signs of weakness is the market hesitates just at support or just above support or just under resistance. And right now it looks like we're hesitating just under support, and that makes me question how strong are traders right here. So big bull bar, probably, I don't know, it'd be interesting. We'll see if they gap up or if the bulls, how much resolve will the bulls have? How much determination will the bulls have? That is the question. I suspect something disappointing, but I do think we're going to go above this high of last Friday, the high of last Friday. So on the 5 minute chart, bar one, we gapped up, and it's a big bar after a gap, probably going to go at least a little bit higher. In general, on the open, better to wait for consecutive bull bars before deciding if the market's always in long or always in short. Bar two, we have a bear bar. For the bears, it's a reversal of the gap up and bar one, but probably buyers below two scaling in lower. And then three, we have a big surprise bar closing below one. Bar one in general has a 25% chance, or really 20% chance, of being the low of the day. So buyers below one, but the odds are we were going to go below one. So if you're buying here, the stop is not right here. I think a lot of traders, if they bought this low, for one, the bulls that bought here and they saw this bar, I think it's okay to exit. Why? Because you're probably going to fall below one. Otherwise, you probably use a wide stop. And then you get big bar three. Three is a big bar, but it was reasonable to buy below two. Whenever you're in a trading range and traders get trapped, the bulls that bought the two low, and you get a big bar like three, often, maybe 60% of the time, you can get a deep pullback testing the breakout point before you get a second leg down. So if you're selling the close of three, it's really better if you can look to sell more on a 50% pullback or even all the way at the breakout point. So when you see four, a bad signal bar for the bulls, and then you see five, a big bull bar, with the tail on top, the bears who are selling cannot panic because it's a breakout test of the two low. And then 6, breakout pullback short for the bears. It's a two-legged pullback on a smaller time frame, up on 4, down on 4, up on 5, down on 6. Probably buyers below 4, buyers below 5, but a second leg down after 3 is likely. And that means we're probably going to go at least one tick below the 4 low. 7, bear bar, but a possible parabolic wedge test of the moving average after a gap up. It's a swing buy above the bar. It's a low probability because it's a bear bar, but it is 3 legs down. 1, 2, 3. So okay to get out of shorts above the bar, or certainly 1 or 2 points above the bar. Surprise bar on 8, big bull bar, but it's testing support. The 1 close, the 2 low, an area where bulls got trapped. So as strong as that bar looks, it's a big bar and it's forcing traders to buy high. It's really better to wait for follow through because this could fail. And the bulls, for the bears, it's a bear bar, but it closed above its midpoint. The bulls, they'll see it as a breakout pullback buy setup. Some of the bears, they sold above the 7 high. And because of that, if they're selling above 7 right here, they will scale in higher. And if they did, they're looking to get out break even around the 50% or the midpoint of bar 8. And that's what led to a second leg up on 10. 10, 8 was strong enough for a second leg, and 9 was a pullback. 10 and 11 consecutive bull bars testing the 2 high. But look what happened to 2 high. The market rallied and sold off. As strong as 10 and 11 looks, 10 is a big body, small tails, but 11 is a smaller body and a bigger tail. That's a warning that something is not quite right. And then 12, we have a doji. So looks like the market's failing right here. 13, probably buyers below 12, scaling in lower. Micro channel since 7, but we have a big bull bar on 8, bad follow through 9, consecutive bull bars 10 and 11, but bad follow through on bar 12. Those reasons increase the probability of more sideways here. And then you can see 13 or 14 went above 13. 13, high one buy, probably sellers above. 15, outside down, probably buyers below 15, but it's a second entry short and a second failed breakout of the 2 high. And the bears who sold above 10, the bears that sold above 7 right here got trapped. And you have to wonder if those bears are going to be relieved. Trading range days are usually forgiving, which means the odds are the market's going to do something to allow those trap traders out. Bears sell above, they sell below, they get out break even here, or they get out at the original entry. So there's probably an 80% chance we're going to get down here, and a 60% chance we're going to get back down to the 7 high. And then 16, a bull bar, second entry buy, but top of a trading range. So there might be more sellers above 16 than buyers. This is still a strong enough rally up to 12 that the bulls will probably get a second leg up. And surprise, surprise, we have a second entry buy 16, but it failed and it led to a second leg down. Give me 2 seconds. I'm going to get a sip of water. So why did this happen? It's really common to get, let me find an example. We had one in the Globex market recently. 5-minute chart. That is the wrong chart. Here it is. This is an opposite example. It's really common to get some sort of breakout testing possible support. And you can see big sell-off testing over here. And it happens pretty regularly. You get something surprising, and then you get a two-legged pullback and a second entry short. But if you go back to, as a reference point, let me pull this up. Give me 1 second here. I'll talk about it in a minute. But anyways, the whole point is it's really common to get something that traps traders into a bad trade and out of a good trade. So the bulls, not saying that this is a great buy, but if they bought here, they get a two-legged pullback, and the bears would sell, bulls would get out, and then you get this strong surprise bar closing up here. So it's really common at the bottom of a trading range to get a bear flag like this that fails and rallies for two legs, and the opposite at the top of the range. Go back to the chart. So we have a second entry buy right here, but big bear bar, probably a second leg down, big bull bar, forcing traders to enter in the middle of the tight trading range. If the audio is bad, people have been saying to close YouTube and restart the video. 17, big bear bar, probably buyers below, but enough of a surprise we're probably going to get a second leg down. So is the audio bad? Let me try this. Let me. How is the okay? Let me do one thing. It'll just take 1 second. Okay, I'm going to test out the audio now once again, but that should have fixed the issue. So bar 17 is a big bear bar closing on its low. Probably going to go at least a little bit lower, but strong enough surprise. Probably going to test the 7 high. 18, we have a doji. Minimum follow through for the bears. It's a bad stop entry by above, but it's also bad follow through for the bears. That tells me the downside is probably limited, but you will have traders selling the close and selling above, betting on a second leg down. Matt says, tough day for a swing trade. Looked like a limit order traders had an easier job of making money. Yeah, that is certainly true. And one of the things about today, days like today, is you look at the daily chart, and when you look at it after the fact, it looks like a very strong trend day. However, when you look at the day in and of itself, there was so much overlap with the day, and that makes it really hard to hold for a swing. So, if you pretty much what I'm saying is there was only a collection of bars that really made the market have such a big rally. TradeStation's almost done loading. Unfortunately, this computer, since I use this computer for TradeStation, what happens is whenever I open TradeStation on this computer, there's a bunch of defaults. So there's a lot of windows and things that open, and I've got to get those. I don't have a second default for these YouTube videos like I do on the other computer. There's a comment, trading range days are a bit rough. They said they're entering when they should be exiting and vice versa. Yeah, that's pretty natural. Trading, what's interesting about, traders, it's kind of interesting. The longer you trade, you start to, kind of go through cycles, if you will. And what I mean by that is traders will, and I'm looking over here to get TradeStation open. What traders do is they start betting on breakouts, but then they start getting chewed up by betting on breakouts all the time. So the next thing they do is instead of betting on breakouts, they start to bet on failed breakouts, and that starts working for them really well. However, what happens is once they start fading, in other words, they keep fading breakouts, selling above bars, buying below bars. But what ends up happening is they start getting just completely chewed up on all the other days. So small pullback trends just completely ruin them. So you have to find a way to find a middle ground. Okay. So the bears, big bear bar, and minimum follow through. It's a bull bar. It's a warning that the market may go a little bit lower, but it may not go all that much lower. But it's still not a great buy above. Bear bar 19, follow through on 20, but a big tail, and look to the left. So what is 19? What is 20 testing on bar 7? It's testing the breakout point on the 7 high. Remember how I said that there's a 60% chance the bears that sell above 7 scale in will make money? Well, look what's happening. They're making money on 20, and that's a trading range mentality. There's probably buyers somewhere below. And you can see that's what happened on 21. 21's a bull bar, but look over the past 6 bars. The bears, they sold above 16, made money. They sold above 18. Now we're triggering a buy above 20. This is a wedge bottom, but it's a tight bear channel, so there's probably sellers somewhere above. In general, this is not really where you want to short. The reality is there's probably sellers not far above, but there's also probably buyers below 21. And because of that, I think a lot of traders would rather look to sell higher. 22, big bear bar. Is it sell to close? No, this is even more of a wedge. So big bear bar, best looking bear bar on 22. This is probably more buy the close than sell the close. 23, bear inside bar. It's a second failed breakout of the 6 breakout point high. It's a failed breakout after 22. I think a lot of traders will look to get out above the prior bar or the current bar. Too much risk that this will be a higher low with 7. Doji 24, probably sellers above, probably buyers below. And then we broke below 22 on 25 and turned up. So the bears that sold the 23 close, the bears that sold the 22 close scaled in higher, made money. And the bulls that bought the 24 low will probably make money, and they did on 26. 26, second entry buy with 23. Bad entry bar for the bulls, bad stop entry for the bulls above 25. But bottom of a trading range, probably buyers somewhere below. Consecutive bull bars 27. Good for the bulls, 3-bar micro channel. A high, 3 new highs ever since 25. Probably going to go at least a little bit higher. And then 28, we have a bull bar. So this is a small bear flag on a smaller time frame, and we're getting an upside. Probably going to test back to this area, and we'll probably get back to the 16 high. So the bulls that bought here and scaled in lower will probably make money. 29, strong bull bar, probably going to go higher. And then 30, another big bull bar. Is this by the close? It's consecutive bull bars. That's good for the bulls, but it's a possible variant of a second leg trap. Rally on 26, 27, pause on 28, and then a breakout on 29 and 30. And 30 is testing prior resistance, the 13 high, the 16 high, testing an area where the bulls got trapped. $31, doji, probably buyers below, but top of a trading range. 32, a bear bar. Looks like it's an inside bar. So it's an inside bar, and that is a contracting market. It's a triangle on a higher time frame, so it's a possible final flag if we go above it. And you can see we did on 33. Are there more buyers or sellers below 33? I suspect that there's more buyers below 33 scaling in lower. But you can see traders got trapped above 28, which means there's probably sellers somewhere above 28 right here. 34, bear bar, probably sellers above, probably buyers below. For the bulls, they see 29 as 30, and 30 is being strong enough for a second leg. So I think most bears are better off waiting for a retest of the 30 high. 35, bigger bear bar, but a bigger tail below 35, testing resistance, the high of 28, probably is gap, but it's probably similar to this area in here. We're closing this gap above 7. We're closing this gap above 28. We're probably going to rally. 36 bull bar, but a big tail, testing the highs up here. For the bulls, they will probably use this bar to take partial profits. I still think we're going to try and get above the 15 high. The 18 bar range is contained and it's fairly small. So you have to imagine we're probably going to try and get a measured move of the range. And with yesterday being as big as it is, today could easily be an inside bar based on last Friday's range. Whenever I say yesterday, I'm referring to the prior US trading session. So yesterday means last Friday because today is Monday. And tomorrow, when I say yesterday, I will be referring to Monday. And you can see bulls taking profits after 36 on 37 and bears selling. For the bears, it's a second leg down after 35, but probably buyers below 37 and scaling in lower. And you can see we closed one tick below the 28 high. So we're in the buy zone. Consecutive bear bars, good for the bears, but a possible second leg trap on a smaller time frame. Down on 35, up on 36, down on 37 and 38. So we could reverse up here. Plus the rally up to 30 is strong enough that it'll probably get a second leg up. And 36 is just one bar. So it is probably not the start of the second leg. 39 bull bar, probably sellers above, but two-legged pullback at support. So this could trap the bears. And then you can see what happened on 40. The bears that sold the close of 38, disappointed 39, getting out break even at the 40 low. 40 is a strong enough bull bar that the market's probably going to go higher. The bears that sold the 38 close and scaled in higher probably disappointed enough that they may just look to get out wherever they can. And if they do, that could lead to a strong rally. Big bull bar on 41, possible climactic two legs up, and possible failed breakout above 31. Expanding triangle and testing near resistance, the 15 high. But I suspect we probably have to get above the 15 high. And then 42, we have a bull bar. 40 and 41 were strong enough that bears probably used 42 to look to buy back shorts at as cheap of a price as possible. 43 inside bar, probably buyers below and at least a small second leg up. And then 44, an outside bar, so tight trading range, a warning that something's not quite right. And then you can see 45, we rallied above 15 and turned down. For the bears, for the bulls, that's the minimum expectation. And the bears, we went above the 18 bar range and failed. The rally up from 25 is tight enough that there's probably buyers below, but I think a lot of traders will get out below 45. The problem with selling below 45 is it's just above the moving average, and that will be a buy zone. But you will have bears selling below 45, taking a chance that we plunge back down to this area. 46, reversal after 45. Possible smart start of a tight bull channel, not clear yet. We have a possible open gap, these highs and these lows. So this is a warning that something is not right for the bears. And then we have another bear bar on 47. It's okay to exit longs. Tight bull channel, yes, but looks like a leg in a trading range. 48 triggered the sell below 47, but we're holding above the moving average, and that is problematic for the bears. The bears, they really need to break a strong breakout below the moving average. Otherwise, you'll have more and more traders buying here, trying to keep the market above the moving average. 49, doji, probably going to go more sideways. And then 50, another doji bar. So tight trading range, the market's in breakout mode. 52, outside up, a little bit of a surprise, probably at least a small second leg up. Bad follow through 53. So a warning that something is not right. It's possible this is a breakout. This is a pullback. We get a small second leg and a reversal. 54, good bar for the bulls, but late in a rally that began on 30 or 25. And then 55, we rallied and pulled back. Doji for the bears. That's good for the bears, but it's not a bear bar closing on its low. That increases the chances of buyers below, but buy climax, pause, another buy climax, pause, another buy climax, pause, overall trading range day. If you're buying the 53, 55 low, you have to be prepared to consider reversing your position. Not a great entry bar for the bears that sold below 55. Bulls looks like they're making money buying below 55. That's good for the bulls, but I suspect after 50, 56, a lot of those bulls that bought the 55 low are disappointed. 57, strong bear bar, and you can see that's what happened. Bulls bought the 55 low, disappointed on 56, trying to exit at the 55 low on 57, and that's why we sold off. Consecutive bear bars, 56, 57. Are we always in short? We might be, but again, the moving average is just above or is just below, and the bears really need to close below the moving average. Otherwise, too much risk that this fails and reverses up. For the bulls, they see it as a 55 or 56, pulled back, sold off on 57. If 58's a bull bar closing on its high, that might trap bears into selling in a small pullback trend. 58, bull bar closing on its high. Possible trap for the bulls, but it's also a possible trap for bears. We're still in a channel and we're testing the moving average. 59, a low one short, probably buyers below. Some bears sold 57, disappointed 58, trying to get out break even at the 57 close on 59. And then you can see 60, we got a second leg down. Two-legged pullback for the bears. Are we always in short? We might be, but it's pretty much a 50% pullback of this channel. Spike, pullback, here's the start of a channel, and we rallied. It's common for channels to start to go sideways around the midpoint. And now the market's deciding, are we going to test the 39 low right here, or are we going to test the high of 55? And right now, it's not all that clear. So these are the two targets, and we're close to the middle. As strong as 60 is, it'll probably have a second leg down, but you know the market's in a trading range, and that will increase the risk of bears getting disappointed. 61, surprisingly big bull bar, probably by the close and going higher, but tight bear channel down to 60, and the upside's probably limited. Bears, they sold the close at 60. They'll probably look to scale in higher. It's also testing the 55 low, the breakout point where the bulls got trapped. Bulls bought the 55 low. They got trapped on the two-legged pullback down to 60. And they may use this rally to get out. $62, doji, probably buyers below scaling and lower. 63, a bear bar, but probably more sideways. You can see bears sold above 60, scaled in, market allowing them out around break even. 64, bull bar closing on its high. Probably, are there more buyers or sellers above? It's a tight trading range. 61's big enough. We'll probably get a second leg up, but it's really not all that clear. And then we have a doji on 65. 65, probably going to go more sideways. 66, doji, sideways bar, probably sellers above, probably buyers below. And 67, big bull bar, but it's testing near the 55 high. So there's probably sellers above 61, sellers near the 55 high, the midpoint of 55. There's and there might be more sellers on the close of 67. And that's what happened on 68. 68, possible two legs up. It's a nested two-legged pullback after the rally to 61. I think it's okay to exit shorts, exit longs below 67. Probably aggressive to sell. If you're selling, you're taking a chance that we plunge to the downside. 69, decent entry bar, but the bears have failed after all day after they get two consecutive bear bars. And we have a close below the moving average. This is the second close below the moving average. Good for the bears, but let's see if they can get a third bear bar. And they failed on 70. 71, doji, probably sellers above, probably buyers below. 72, getting a second leg down, but you can see what happened. Bulls that bought the 71 low, scaling in lower, getting out break even. And we pretty much rallied back into the close. So for the bears, they got trapped on 60. It was reasonable to sell 60, but it was a two-legged pullback as well, so it's dangerous to sell 60. And you can see what happened. The market sold off on 73, tested the 60 close, and turned up. For stop entries, certainly not an easy day for stop entries. I thought it was okay to sell below 15, but if you do, you got to be prepared to hold above 16. And I thought it was okay to probably buy above 27 or 28. You can buy above 40. You can, maybe you buy above 73. And that's really it. Stop entries all through here, not that easy. If you look at the market, it was pretty much a trading range day for the first 40 bars. And even really for most of the day, we had a trading range here. We drifted up a little bit and had a trading range here and then a strong rally. But if you take away bar one opened at 1825, by bar 72, the market has gone up 10 points. And really, by bar 72, if you think about it, the high of 15 was the close of 72. So most of the range for a lot of the day was developed in the first 18 bars. And then late in the day, we got a decent rally. As far as buy the close, that's tough. Through here, it's buy the close, but the follow through is usually one or two bars. Buy the close 8, but follow through one or two bars. If you sell the close of 3, you have a deep pullback, you get a small second leg. If you sell the close of 17 and 18, you get a small second leg down. I thought it was okay to buy the close 27, 28 here. And do you buy the close of the 40? I don't know. You might take a stop entry there, but not ideal. And probably, is it buy the close 76, 77? You can, but rather aggressive. Limit orders, obviously lots of limit order trades today. Bulls buying below bars, scaling in lower. Bears selling above bars, scaling in higher. For the bulls, it's a buy below 18 or 19. And for the bears, it's a sell above 13. You can buy below 21. You can buy below 24. You can sell above 32. You can buy below 34. Sell above these bars, buy below these bars. And you can even sell above 52, but you need a wide stop. And you can see those bulls made money. Those bears made money. And it was really like that all back and forth. Question, can it be profitable to scalp with limit orders if you can't scale in? That is an interesting question. And it's really a challenging. I will say this. It is more difficult to make a profit scalping and not scaling in. And let's take a few examples. So when you say scalping, there's several ways you could be thinking. You could be talking about limit orders. You could be talking about stop entries or breakouts. My only problem here is There's a difference between scalping when you see bars like 12 or 10, 11, and 12, where you buy the close and you scalp out, or you see bars like 54 or 55 and you sell the close for a second leg. That's scalping. If you sell the close at 55 or sell above 56 and you get out 3 bars later on 59, sure, you made a decent profit, but the reality is you scalped. You weren't even holding above a pullback. Now, the challenge here is, what if you sell the 3 close? What do you do on 4 and 5? Well, the problem is, if you can't scale in, let's say you sell the 3 close and you can't scale in on 4 and 5, then you're kind of in a difficult situation because your risk, this is your actual risk right here. And that's your target for 1 times your actual risk. But what's the odds that the market gets down there? Big bear bar, deep pullback, there's probably buyers below. And if you had a target down here, you didn't get filled. Big bull bar, few legs up, so you could scalp out there, but really not easy. And then if you sold here or sold here, maybe you get out there, but that's assuming you did it perfect. If you bought the close of 30 and you can't scale in below 30, what do you do on 36? You're probably forced to get out, break even. So for me, if I couldn't scale in, what do you do? I would try and enter on pullbacks. So if you see a big bear bar, I would try and sell, maybe halfway up or sell at the breakout point. So you see this bar, I would try and sell in the upper portion, betting on a second leg. Otherwise, I would try and trade stop entries. And, you know, the reality is if you can't scale in, it's easier if you can scale in. But I think most traders should focus on always in trading. Always in, if you had to be in the market long or short, that is the always in direction, whichever one you pick. So bar 3, are we always in short? I don't know, we might be. It's probably strong enough for a second leg, but it's a breakout. We don't have any follow through. Better look to sell a pullback. And if you didn't do anything there, big bull bar, bears get out, bulls probably buy, few bars up, but you see 10 and 11 and 12, possible fail break out of this range, probably going to go more sideways here. And 13 and 14 started to get overlap. 15 outside down. If the bulls were still long, the bears, they probably get out below 15. Bears can sell, but tight trading range, forcing traders to sell low. Probably going to get at least a second leg down. 18, bears don't have to exit. 21, do they have to exit? They can, but they can also put their stop 1 tick above 21, and you can see what happened. It didn't trigger. So those bears are still short, but they probably get out above this bar. Bulls, they start buying somewhere in here. 30 consecutive bull bars, but testing this range. They probably get out maybe below that bar, but you can see the challenge. If you enter on stops and exit below bars or above bars, you're going to end up selling a lot of times, or you're going to end up trading a lot of times in the middle of the range, which is not ideal. However, always in overall is certainly a good way to trade. Do you ever pay attention to order books or dome trading, depth of market trading? I do not, but there's quite a few people that do. I'm not the right person to answer that question. For me, I just look at price action in the bars. So I look at context, support and resistance, and the overall structure of the bars. Yes, today was a mean reversion kind of day. Can you please explain the logic behind these vacuum days or sells, behind the vacuum buys and sells? Thank you. Sure, give me just a second. This is an interesting question. And when you think about it, every breakout is a vacuum test of support and resistance. You have to think about the goal of a market. The goal of a market is to find the average price, the equal, the fair price. And because of that, the market's goal is to tighten the bid ask spread. It's to have a lot of offers and buys somewhere in the middle. So if you want to sell something, there's buyers not far from the average price. Same thing for the opposite. And because of that, you're going to get a lot of sideways trading. But what that also means is a lot of times the market's probing up and down. So you see bar 8, big bull bar going higher. The market's probing to the upside, and it might get a small second leg, maybe a third, but it's probably not going to go all that far. You see bar 16 or 17 being a big bear bar closing on its low, and you think to yourself, finally the market's going to break strongly to the downside. However, you see the follow through on 18. It's a weak follow through bar. And because of that, it's a weak follow through bar. You get a few legs down and the market goes sideways. 27, 28, 29, big bull bar. But then you get 30. And when you look to the left, you still have all these bars and the market goes sideways. Compare that to Friday. We start to get this sell off and it's getting strong, but it still looks like a leg in a trading range. But then you get 54 and then you get 55. But even 55, notice it's a vacuum test all the way over here. We got a few legs down, but we ultimately came right back to the 55 low. So the point is, most moves, you know, if you really think about it, it's very common for the market to it's easy to identify when something's overdone. In other words, climactic, but it's difficult to identify when it's not. So you see a rally like 15 to 24, it's a tight bull channel, it's a small pullback trend. You look to the left, there's sellers probably up here, but it's not clearly overdone. Climactic bar formed a gap, started going a little bit higher. Looks like the gap stayed open. But then you see 36 and then 39, and it's climactic. That increases the chances that the market's going to pull back. But a lot of times you'll see these moves as vacuums. 6 and 7 and 8, it's a sell climax testing the prior day's lows. Somewhere up here, it's a buy vacuum. Big bear bar, sell vacuum. And that happens all the time. Big bull bars right here, but look to the left. It's testing the bulls that bought this low where they got trapped. I do not pay. Someone asked if I pay attention to volume. I do not pay attention to volume. Here's a comment. Always in is great in trends, but hard in channels and ranges. Yeah. And the reason it's hard in channels and trading ranges is because a channel is a transition into a trading range. Okay. So that's all the time I have today. Tomorrow, there will be an end of day. There'll be a review in the trading room. And then Wednesday, we'll be back on YouTube. I'm planning on hosting a Q&A just like Saturday on Friday around 4 p.m. Central Time, 5 p.m. Eastern Time. In other words, it'll be about an hour after the market closes. So plan on that being on Friday. I will use this new computer going forward, so that should prevent any audio issues. All right, thanks everyone for watching, and I will talk to everybody soon.